People are speculating on large, dramatic price objectives as if they were inevitable, and there has been a lot of talk lately about silver rising nearly straight up. We're going to separate the thrill from the danger in this video, and you'll leave feeling much more at ease and in charge of your choices. It's Monday, February 23rd Eastern Time, by the way. I'm always interested in how far this message travels, so please leave a comment with the day and date you're viewing from. To let me know you agree with me, please hit the subscribe button and leave a comment for future Ledger Anna. Here's the feeling, in case you haven't noticed how divided everyone is on this move. One group is certain that this is only the beginning and that, like a straight line, we are on our way to triple-digit silver and multi-million-dollar gold. According to the other group, this is the peak, the blow-off, and the final rush of adrenaline before gravity sets in. Additionally, I'm going to tell you something that may initially irritate you, but it's the truth. Though not on the same timeline, both groups may be correct. Now, let's take a quick gut check. Just be honest, there's no pressure. Are you viewing this because you're feeling fantastic and you already have medals? Or are you watching this because of fear that you missed it and are considering pursuing it? Leave a remark if you've already done so or are considering it. When I read those, I can sense where you're headed. Alright, so this is the main issue with a parabolic move. Your brain stops performing arithmetic when something becomes vertical. It begins to tell stories. When it doubles again, you begin to see what you'll do, where you'll sell, how you'll feel, and how you'll tell others you called it. The market loves to put you to the test at that precise moment. I will thus outline a framework that I recently heard from a very experienced macro voice and reconstruct it in a way that you may utilize. The structure is straightforward. A short-term overbought situation must be distinguished from a long-term secular trend. That's all. You will ultimately make the worst choice at the worst moment if you confuse the two. I'll demonstrate what I mean. Silver and gold are two different animals. They move differently, but they rhyme. Furthermore, they do not penalize you in the same manner. Typically, gold is the slow heavyweight. It moves with global reserves, real rates, policy, deep pockets, and other things that don't alter quickly. The lighter weight that can sprint is silver. Additionally, it can appear brilliant while sprinting until it doesn't. When everyone wants the same thing at the same moment, silver is the one who gets caught up in these unexpected outbursts. It can quickly become a crowd trade. Furthermore, there is no risk that a crowd trade won't be able to rise when it begins to trend in the same direction. There is a chance that the escape door will become smaller. Here's another twist that makes silver particularly challenging at the moment. Silver is no longer simply exchanged like gold's gleaming relative. Its demand profile has been shifting more in favor of industry over the past few years. According to the most recent industry survey, industrial applications, rather than jewelry, coins, or collectibles, account for more than half of the world's demand for silver. And a significant portion of that industrial demand is linked to rapidly expanding technologies, including electrification and solar, whether the economy is doing well or not. Solar is expected to play a major role in the projected growth in global renewable power capacity until the end of the decade. That sounds bullish, and it may be, but it also produces a new type of volatility because when silver is being tugged in two different directions at the same time, industrial consumption on one side and monetary fear on the other, you can get these sudden emotional spikes where the price of silver exceeds reality. And in the early months of this year, we witnessed that. After putting up a spectacular dash, silver quickly gave up a significant portion of that move. It was a "where did my profit go" kind of shift rather than a steady dip. Therefore, you need to ask yourself a tough question if your aim is to just sell if it lowers. Will you freeze or will you sell when it's dropping? I keep returning to risk management because of this. Silver is the type of asset that incentivizes preparedness and penalizes improvisation, not because I want to come across as cautious. You must therefore pay close attention to this if you're looking at a chart that resembles a rocket. Riding the trend is not the same as chasing the rocket. Distinct regulations, distinct danger, and distinct thinking. You don't have to say sorry to anyone for taking some money off the table if you've been in the business for a while and are sitting on a sizable gain. By paying themselves, no one was ever destroyed, and I am aware that someone will accuse you of being bearish as soon as you offer to take profits. No, it is not bearish to take profits, it's grown up. The market does this by persuading you that since it rose quickly, it must continue to rise quickly. And markets don't operate that way. Emotions function in this way. Here's a useful way to approach things then. Let's say the speed limit is standard and you are traveling on a highway. Then all of a sudden you're traveling twice as fast. It is possible that you are still headed in the right way. Your margin of error is gone, even though you may still be traveling on the same highway. A small hiccup in the road turns into an issue. A small turn turns into a spin. An overbought condition is just that. It doesn't make any claims about the final destination. It makes a statement on speed. This is when things get really intriguing, and most people don't see it. Your brain attempts to match patterns when silver becomes parabolic because it begins to resemble other well-known parabos from history. You begin to think, this is that moment. This is the big one. However, if you disregard context, pattern matching can be harmful. Let's now discuss one of the most heinous instances of a parabolic chart that ends poorly. Because it happened so quickly, the U.S. stock market crashed into a wall in the late 1980s in a way that people still discuss. The broad index fell more than a fifth in a single day. People once thought they were okay when they went to bed and woke up with the impression that the floor had vanished. Additionally, you are aware of the appearance of the charts at that point in time. They appeared robust. They appeared to be unstoppable. They gave the impression that things were different this time, but they weren't. Am I correct in assuming that silver will carry out the same action tomorrow? No, that is ineffective and lazy. This is what I'm saying. The conditions for a severe correction are created when a chart turns into a near vertical line. The nuance is that the larger bull market is still going strong. This is where you may simultaneously be cautious and bullish. What are you going to do with that? You remain calm. It's not all you sell. Additionally, you avoid making significant additions at the peak of the emotional cycle. You create flexibility. In order to avoid having to observe from the sidelines in the event of a pullback that causes everyone to doubt the trend, you maintain some liquidity. Since that's what experts do, you have the freedom to intervene when prices are lower. They are not required to foresee the summit. They take a position that will allow them to survive whatever comes next. Now, let's answer the question that comes up every time you say, pull back. How about the previous instance, which occurred in the early 2000s and again in the early 2010s? After a significant surge in metals, there was a protracted period of frustration. The anguish is remembered, the headlines stick in people's minds, and the worry is, are we only preparing for that to happen again? The key is right here. The drivers are important. Furthermore, the motorist who has changed in appearance is not a retail story. The story isn't about jewelry. The story isn't about folks waiting in line to purchase sparkly bars. It's a sector official story. Central banks purchased little under 900 tons of gold last year, according to previously released figures. That is a huge flow, and it has nothing to do with feelings. Policy and reserve management are the sources of it. Examine official reserve reporting to get a sense of how commonplace gold has grown within the system. According to market value, gold made up about 1/5 of worldwide reserves in the most recent Global Reserve Appendix. It's no longer a fringe wager. That represents a large portion of global official savings. It's also not dispersed equally. The bulk of the physical stock is still held by advanced economies, but emerging economies have been making more incremental purchases. Therefore, it's not quite accurate to argue that retail is the only factor driving this. Reserve managers are examining a world where payment systems, sanctions, and geopolitics are now discussed in relation to investments. Gold is one of the few solutions to the question, what do we own that has no counterparty and can't be frozen with a keystroke? Does that imply that gold only rises now? No. It indicates that compared to periods when central banks were net sellers, the floor under long-term demand is more resilient. It also implies that you should keep a close eye on the official sector, because it means more than any headline when the official sector alters its behavior. This is the detail that is often missed. Even though that figure was still enormous, it was slower than it had been in previous years. To put it another way, when prices get crazy, even the world's largest buyer may slow down. That is significant because it provides us with a more impartial perspective. Therefore, the positive assumption is that central banks will not always buy. Although there are catalysts that could alter the pace, the more plausible argument is that central banks have been diversifying their holdings, which, as long as it continues, creates a structural tailwind for gold. A portion of the buying may halt if the volatility remains high. The flow may alter as policy priorities change. That can definitely alter the short-term course, but it doesn't immediately ruin the long-term narrative. I want you to think in time frames because of this. This is part of the new background that many metal commentators overlook, so let's zoom out even more for a moment. Gold and confidence have a strange relationship. Not with the assurance that I feel fine. Assurance that I have faith in the system. A high level of confidence reduces the demand for gold. They prefer to hold assets that generate revenue. They prefer to grow on their own. They prefer to take the chance. Gold begins to resemble an insurance policy more than an antique relic as confidence wanes. Furthermore, confidence is difficult at the moment. Although it has subsided from its peak, our inflation is still alive. According to the most recent publicly accessible inflation data, headline consumer prices are still below the Fed's objective, with year-over-year prices in the low twos. Additionally, the most recent monthly report of the Fed's preferred inflation measure, which policymakers closely monitor, showed a reading of slightly under 3%. While it's not a crisis, it's also not a goal completed. What does the Fed do then? The Fed is maintaining its target range just above 3.5%, as per the most recent decision. The market is attempting to front-run the narrative over the next few weeks as they essentially say, "We're not rushing, and the next scheduled policy meeting is in mid-March." For metals, this is significant since actual yields count. Gold struggles when inflation-protected rates are high. Gold has breathing room when they relax. Furthermore, those long-dated inflation-protected yields have recently been floating around 2%, which isn't exactly a present for gold bulls. Gold has been battling through this obstacle. Okay, but what happens to real yields? Should be your first question when someone tells you that gold can only go higher from here, since the route becomes choppier if real yields continue to be sticky. Bonds are the silent motor that powers a lot of things, which gets us to the bond market. The rising yields in Japan and their impact on global rates have been the subject of much discussion, and people's favorite simplistic narrative is that bonds are repulsive because debt is too high. Yes, but occasionally the narrative is more nuanced. Here's another interpretation that's worth thinking about. Japan was trapped in a world where prices hardly changed for years. Indeed, Japan's government still owes a huge amount of money. The gross debt ratio remains above 200% of GDP on the most recent global data set. That's huge by any standard measure. Therefore, I'm not suggesting that debt is unimportant if someone tells you otherwise. In other words, the bond market does not necessarily respond to the amount of debt. It occasionally responds to the story's trajectory. Even while the debt load is still enormous, the ratio may appear to improve if the denominator, nominal GDP, begins to expand more quickly as a result of prices finally rising. And what comes next is important to bond traders: wage developments, inflation expectations, and the central bank's speed of action. Therefore, the surge in Japanese yields may be more a result of a fear of falling behind than a fear of default. Because it alters what you should watch, that distinction is significant. The inflation trajectory and the policy reaction, not the debt headline. That alters conduct. Wages are altered. Politics is altered. It alters the way a central bank functions. Then inflation returns. Additionally, the return of inflation, even if it is not severe, alters the expectations of the bond market. It forces the central bank to make changes. As wage dynamics develop, Japan's central bank anticipates that inflation pressures would first decrease before re-escalating. That's essentially a tactful way of emphasizing that policy needs to remain flexible since the inflation story isn't clear-cut. Inflation in Japan has also been declining recently, with core inflation hovering around the target region. Therefore, there is more to the movement of Japanese rates than merely debt fear. The market may also be claiming that policy is lagging behind. Make up lost time. This is the spillover now. The worldwide relative value shifts when a major market reprices its bond curve. Hedging costs fluctuate, traders adapt, and money flows. Additionally, you can feel it through the price of long-dated bonds anywhere else, even if you don't live close to Japan. Now let's return to the United States, as this is where the rivalry became heated. Politics, risk, and duration. Investors who believe that the next central bank leadership transition may result in a drastically different strategy exhibit a particular type of anxiety. Not a minor adjustment, a new way of thinking, and people don't want a protracted duration when that fear manifests. If they believe inflation may resurface, they do not want to lock in a return for decades. The question therefore becomes, are yields shifting as a result of the expanding economy? Or are yields shifting as a result of the repricing of uncertainty? It can be both at times. Here's where we need to exercise caution, because you risk missing the deadline if you're developing a metal thesis solely based on what the government will print. Over time, printing may be bullish for metals, but in the near term, the market may still favor higher real rates, and metals may still get smashed around by higher real yields. You must therefore have a strategy that endures the tug of war. Now, the stock market, more especially the bubble question, was the next significant subject to appear in that rival screenplay. Let's discuss it. Bubbles are typically spoken in an emotive manner. There is euphoria among all. Calls are being purchased by my cousin. It's like being 20-something again. It's insufficient, but it's not worthless. Examining valuation and contrasting it with alternatives is a better approach. Additionally, the cyclically adjusted price-to-earnings ratio, which smooths earnings over a 10-year period, is one of the most talked about long-term valuation metrics. That measure has been in the upper 30s at the moment, and depending on the update, it has been flirting with 40. The market doesn't have to plummet tomorrow because of that. It indicates that the market is set for a scenario in which everything goes according to plan. Additionally, a market that is priced for a lot of success becomes vulnerable to shocks. Now there's something worth arguing about in the competition script. When comparing the inferred earnings yield from those prices to long-term inflation-protected yields, the basic idea is that the so-called additional benefit for owning stocks decreases if bonds are providing a real return that is competitive with what stocks are producing. That's a legitimate worry. Here is the skeptic's argument, however. What earnings are we discussing here? Using 10-year smoothed earnings yields a single image. You gain another if you use forward earnings. A third picture results from using profit margins that could or might not be sustainable. Therefore, while relative valuation may appear stretched, the precise negative premium claim may vary depending on presumptions. And I'm not attempting to dissuade you from exercising caution. The reverse is true. I'm trying to tell you not to base your entire perspective on a single calculation. It should be used as a warning light rather than a steering wheel. And here is a straightforward method for operationalizing the warning signal. It's not necessary to foresee a crash when valuations are stretched. All you have to do is acknowledge that future returns are often lower and drawdowns are typically more severe. I enjoy looking at several thermometers at once because of this. Credit spreads, actual rates, valuations, and liquidity. And this is the bit about liquidity that many overlook. When everyone is pessimistic, the market doesn't crash. When everyone is in the same position, they break, and then they are forced to relax by anything. Therefore, it's okay if you plan to purchase risky assets in a high-priced market. However, don't treat them as though there are no risks, as if you were renting them. Own them. Another common assertion is that the majority of the market is currently passive, with a significant portion of investors simply purchasing indexes without question. Although it is overstated, there is some truth to it. In fact, indexed vehicles own somewhat more than half of the total assets of long-term mutual funds and ETFs, with active funds holding a relatively high percentage, according to the most recent industry survey of fund and ETF holdings. Although passive is effective, it isn't 90% of everything. Why is that important? Because when passive dominance is exaggerated, it can be used to suggest that price discovery has died and that a crash is certain. It doesn't operate that way. Markets may continue to be pricey for a while. They are also capable of forceful correction. It's not automatic, though. It is contingent, and liquidity is frequently the most important criterion. Since this is the glue that binds a true plan together, let's sew these pieces together. Investors begin searching for assets that are not dependent on ideal growth if stocks are priced high. Bonds are providing respectable real rates, and inflation is sticky enough that the Fed cannot just declare triumph. That's the home of gold. When you believe that the future may not behave as you expect, gold is the asset you possess. Silver, however, is unique. Silver serves as an industrial input in addition to being a monetary metal. On certain days, it may behave like gold, while on other days, it may behave like a high-beta commodity. Therefore, during a bull market, silver may soar higher, and during a risk-off period, it may be hit hard. And for that reason, the word parabolic is extremely important. The person bearing the most timing risk is the one who purchases after the parabolic move. I want you to answer this important question for yourself, and since it gives me a lot of insight into your thinking, I really want you to leave a remark. Would you be relieved that you could buy lower if silver pulled back forcefully, or would you be terrified that you had to buy at the top? Tell the truth, panic or relief, because your response indicates if you are currently in the ideal position. All right, now I want to discuss a scenario that practically no one wants to discuss because it seems dull. Yet it frequently occurs in these cycles. What if the route, not the destination, is the source of the agony and the metals bull market is real? In other words, you might be correct in the long run and still be shook out in the near term. At this point, position sizing and hedging become crucial. Getting fancy is not necessary. All you have to do is quit thinking in absolutes. Rebalancing somewhat toward gold or even cash will help you have dry powder if you're heavy in silver due to excitement. You might just reduce some exposure and let the rest ride if you're already diversified. You don't have to buy today if you're not interested at all. The market will provide you a better entrance, so you may wait for it. Markets always do. The only question is if you'll be able to tolerate it with patience. Now, the notion that governments won't abruptly default was another important beat in the rival screenplay. They'll puff up. And for nations that use reserve currency, that is usually an acceptable base case. The first lever is not default. Financial repression, taxes, regulations, and inflation usually come before, sorry, we're not paying. For investors, however, default is not the more intriguing risk. It's the manner in which the adjustment takes place. Through yield curves and auctions, the modification can occasionally occur covertly. Sometimes it occurs as a result of unexpected changes in policy. Occasionally, correlations flip due to abrupt shifts in risk appetite. I don't want you to support chaos because of this. Be careful what you wish for. People often say, I hope the system breaks, then my metal goes to the moon. There will be more than just higher costs if the system truly malfunctions. The plumbing is busted. Liquidity is frozen. Mid-game is changing the rules. It's limitations on tax reporting. Who knows? It's not a victory. It's a mess. Repricing without collapsing is what you desire. You see a world in which you can truly transact, where risk is fairly valued, and where metals are acknowledged. All right, let's return to the last question from that competitive exchange. Do you like anything else? Because this is the point at which people either become realistic or simply continue to argue online. Getting married to one asset isn't the goal. Building a portfolio that can manage a variety of outcomes is the goal. Here are some themes that have emerged in recent market updates, and I will present them in a manner that does not involve stock selection. It's a map. International stocks come first. Valuation is one of the reasons why people continue to search outside of the US. Even though the headlines are frightening, other places may appear more rational when US valuations are stretched. That does not imply that they are secure. It indicates a different beginning price. Additionally, there is a recurring pattern in that global bucket regarding regions of Asia where population growth, manufacturing, and rising consumption are driving growth. The second is European aerospace and defense. Regardless of political affiliation, defense spending has been increasing for many years. This isn't a passing trend. Certain industry supply chains typically experience continuous demand as a result of this multi-year restoration. Infrastructure for energy comes in third. People misinterpret this one because they believe energy to signify only one thing. Oil prices are not a gamble on energy infrastructure. It's a wager on the economy's transmission, pipelines, power grids, and dependability. And the grid is under stress from electrification and data expansion, which is why this continues happening. The lines and transformers still need to be constructed, regardless of how you feel about the trend. Fourth, local currency bonds for emerging markets. It's a subtle one. Although it's not a free lunch, such bonds may provide an alternative form of diversification if local returns are appealing and the currency is depreciating. You size it appropriately because you're taking on currency and political risk. I don't want you to lose the thread, so allow me to draw you back to the center. This is not a buy this, sell that video. The message of this video is to avoid being emotionally ruined by a parabolic chart. I want you to hear the punchline correctly, so here it is. The long-term outlook for gold can still be positive as long as economic uncertainty and official demand remain high. If both monetary and industrial demand continue to be positive, silver's long-term outlook can still be positive. However, when the chart turns vertical, the short-term risk in silver in particular increases significantly. Therefore, risk management, not hero trades, is the best course of action for the majority of people. One more thing though, because charts have nothing to do with this. This is where people truly make life-changing decisions. Many viewers are trying to construct something right now, so hearing that it's feasible is important. If you're successful, share your experience in the comments so that others may stay inspired. All right, so what do I anticipate happening next? I believe there is a window of opportunity for a significant decline, particularly in the busiest areas of the market. If there is a retreat, I believe it will cause people to wonder if the larger trend is still going strong. For those who did not become overly leveraged at the top, that is precisely why it can turn into an opportunity. This is my last question for you, and I sincerely hope you will respond. Do you want exposure to silver because you can withstand volatility and understand the thesis? Or do you want it because you watched it rise and don't want to feel excluded? FOMO or thesis? Enter it. FOMO or thesis. Additionally, avoid reading too many headlines if you're new here. Binging. Before you make any purchases, write down your entry, exit, and maximum pain. You are not investing if you are unable to define those three terms. All you can do is hope. Furthermore, in markets, hope is not a strategy. And then do one easy action now. I'll be following this with you as the next episode develops, so if you haven't already, subscribe. Okay, that concludes today. To be clear, this movie does not contain any financial advice. It's instructive commentary designed to improve your ability to think, ask insightful questions, and control risk. Before making any investing decisions, you should conduct your own research and take your unique circumstances into account.